Hey everyone, I'm Bradford with a Pen and Pinch Guide to Personal Finance. First, make sure you hit that like button so we know to make more videos like it. If you're watching this video, chances are you're trying to figure out whether a 30-year or a 15-year mortgage is going to be the best fit for you and your finances. I'm going to break down what are the pros and cons of each term length. I'll give you an example of how much money you're going to actually be paying over the life of the loan in each instance, and I'm going to help you figure out what is going to be the best term length for your situation. Let's start with a 15-year mortgage. A lot of advocates for a 15-year mortgage kind of follow the Dave Ramsey thought with regards to debt, which is that they need to avoid debt as much as possible with the exception of getting a mortgage, because most people are not going to be able to gather the cash together to be able to buy a house outright. A 15-year mortgage forces you to buckle down and get rid of your debt in half the time compared to getting a 30-year mortgage. As an added bonus, because your term length is shorter, you're less of a risk to the bank, which means you're going to get a better interest rate on your mortgage. That could be anywhere between 1/4 and 0.5%, but your results may vary. Even though that seems like such a small value, over the lifetime of the loan, that'll make a big difference. Now, the biggest drawback of getting a 15-year mortgage is just that it is a 15-year mortgage and you are locked into paying off your mortgage in 15 years. That means you're going to have a much larger monthly payment and a lot more of your monthly income is going to be tied up in paying your mortgage. Now that gives you a lot less flexibility in terms of choosing to invest the difference, or if an emergency comes up, you're gonna have to pull money from someplace else because at least a good solid chunk of your money is gonna be tied up in your mortgage payment. And that leads into the pros and cons of getting a 30-year mortgage. So a lot of the advocates of a 30-year mortgage are gonna be a big advocate of using leverage, i.e. debt, to accelerate the rate of earning money. The best example here is if you take a 30-year mortgage and a 15-year mortgage, there's gonna be a pretty substantial difference in the monthly payment. Now, if you just take that difference in monthly payment and you invest it in, say, an S&P 500 tracking ETF with just a relatively conservative 6 to 8% annual ROI, you will more than make up the extra amount of money that you're paying in interest by having a 30-year loan with the return on investment that you're getting by investing the difference in the first place. And with a lower monthly payment, you have a lot more flexibility in what you're going to do with your money. Yes, you still have a mortgage and you are locked in. You are required to pay that amount of money every single month. But by having a lower monthly payment, you have that extra flexibility to either save some money, invest it, pay down your house faster. Just because you have a 30-year mortgage doesn't mean you have to wait the full 30 years to pay it off. You can pay a 30-year mortgage off in 15 years just by adding extra money to the principal every single month. And probably the best benefit of that extra flexibility is that if some sort of emergency comes up, you can divert some of the money away that you were investing, handle the emergency, and then return to things as normal. But just like with the 15-year mortgage, the biggest benefit of having a 30-year mortgage is also its biggest drawback. That flexibility you have with your money is a double-edged sword. If you can be diligent, you make sure you invest the difference in the mortgage payments, and you continue to do that each and every month, it can only be a net positive. But if instead of investing the difference or paying down your mortgage faster, you decide to use it to inflate your lifestyle, yes, in the end, you're going to end up paying substantially more for a house by going with a 30-year mortgage as opposed to the 15-year mortgage. Now, as for myself and my wife, when we first bought our home that we currently live in, I was all aboard the Ramsey train saying, hey, absolutely have to get that 15-year mortgage, lock it in, pay off debt as quickly as possible because debt is bad. Now that I've grown a little bit, both as an individual and specifically with regards to my finances, I am never again going to get a 15-year mortgage because I know by lengthening the time of the loan, I have more flexibility and I can actually invest that money and use it to work for me better. Right now I'm going through the process of refinancing my home so that way I can have that 30-year mortgage length, have the lower monthly payments, and when it comes time for me to move, I have the option of renting my house out to be able to generate a new source of passive income. And looking just over the past 2 years, if we had decided to go with a 30-year mortgage from the get-go and invested the difference in monthly payments, our investment account would have several tens of thousands of dollars more in it just because of the capital gains we would have experienced due to how the market has grown over the past couple years. Now let's look at an example that I made in Excel to illustrate the differences between a 15-year and a 30-year mortgage. So the basic assumptions that I made is that both mortgages are going to be for $250,000, down payments aside, and the interest rates are assigned to each. For the 30-year mortgage, I said 3.5%, and for the 15-year mortgage, because you would have a slightly lower interest rate, I set 3.25%. And then I just used the amortization function in Excel using the I-PMT and the P-PMT to calculate the interest payments for each period, as well as the actual principal payments for each period. And that's how I figured out how much money you are going to be spending in total in each situation. Now, over the life of the loan, if you decided to go with a 15-year mortgage, you're going to end up spending just shy of $320,000 all in for the price of that home. That contrasts with a 30-year mortgage where all in, because you have a much longer length where you're paying interest, you're gonna be paying just shy of $410,000 for the total price of that mortgage. Now that's almost $90,000 more that you are paying for the same property by going with a 30-year mortgage as compared to a 15-year mortgage. So if that is all you didn't invest the difference, you just used it for lifestyle inflation, the 15-year mortgage is definitely gonna be the better option, because if you just inflate your lifestyle and you're not investing any of that difference in terms of monthly payments, the 30-year mortgage is significantly more expensive, almost getting into the six-figure range. But if instead of letting your lifestyle increase, what you did instead was invest the difference in the monthly payments, let's say you put it into an S&P 500 tracking ETF with a conservative 6% ROI over the course of the 30 years. Well, yes, you would have still ended up paying almost $90,000 more for the price of the home based on having that longer term length and the slightly more interest. At the end of that, the total amount of your investments would be worth almost $650,000. Even when you take into account the increased amount of interest you're paying for the mortgage, you would have netted over $500,000 more by choosing to go with a 30-year mortgage and investing the difference in terms of the monthly payments. Now, while that entire example oversimplifies how things actually are, it does go to the point that if you are diligent about your finances, you can use a 30-year mortgage and use the benefits of leverage to accelerate your wealth earning journey. So how do you figure out which length of mortgage is right for you? Now, as I kind of touched on previously, if you're the type of person that if you have a lower monthly payment, you're much more likely to inflate your standard of living, the 15-year mortgage is going to be a much better choice because it forces you to at least invest back into the equity of your home, whereas instead of you just going out to eat or going on more vacations. But on the other hand, if you can take the difference in the monthly payment and you can invest it, or you use it to pay down your mortgage, or use it in some other manner that is helping you build wealth instead of just living in the moment, a 30-year mortgage is going to be a much better option. And if the hot housing market right now has you concerned about whether or not you should buy in the current housing market or you should continue to rent, check out this video I'm dropping right here, which covers that exact topic. I want to thank you for joining me today, and until next time, just remember to pinch a little.